All right. Hello and welcome to the Rent to Own Cash Cow Formula, Module 1, where we're covering the basics plus risks and rewards. So some ground rules. The replay will be public. So public as far as the membership portal, past or present and future members, of course, will have access to that. So just so you know, you don't want to take your live video to the bathtub, for instance. That's a friend of mine was telling me that actually happened once. And you can type your questions in the chat box or wait until the end of the segment when we have a question period, and then you can unmute yourself and ask the question out loud. And otherwise, make sure your mic is muted. And if I am going too quickly, then please let me know, because sometimes I get excited and I might need my speed checked. And of course, you will have access to the membership portal for replays, documents, transcripts, all of that. And that's usually in there within a few days after the session. And please refrain from sharing documents and content. A lot of this I spent a lot of time working on and writing and perfecting, so we want to refrain from sharing. So before we start, I want to know a bit more about you. So what sort of experience you have with rental properties in general, how long you've been doing it, if you have a good handful of doors, and the location, so around the city and province that you're in, and if you have any experience with rent to own, and also what you hope to do with this training, if you're looking for an exit from a property or two, or if you're looking for an investment strategy with money partners to do tenant first. So you can either unmute yourself and share or put something in the chat box. So if somebody wants to share, that would be great.
Yeah, I'll start, Charlene. So I've got like 4 or 5 doors here in Vancouver, and inadvertently, like undeliberately, ended up with this foreclosure in Saskatoon. And maybe you know the story there. And so most people just took a big hit and walked away. But I do get that this could be a way to minimize the loss on that. And I have a general understanding of how RTO works, but I mainly understand that the specific wording, et cetera, is a key thing.
Definitely. All right. Anyone else want to share?
It's Daryl. Yeah, we have a couple of condos, and one or two we potentially could use the rent to own to sell. Had a real bad experience renting at one time. I had a renter who was a friend of my ex-wife, who when they moved out, they even took the light fixtures. So
where are these condos?
Canmore.
Oh, okay. Canmore is a good place for condos.
I'm in Calgary. Yeah.
Perfect. All right. Okay. Anybody else?
Hello.
Hi, Calvin.
How are you?
Fine. How are you?
Good. All right. Let me see here. So I have a few doors, and what I'm thinking is, regardless of whether you're trying to wholesale or acquire properties for yourself, the rent to own strategy is just another exit that could probably get you a lot more than an assignment fee, right?
Yeah.
Yeah. So, and I like the idea of being able to attract the private money, so you can develop relationships with the private lenders through having a predetermined kind of contract for them to look into, but then now you have them in your contact list. So that's just another benefit.
Oh, exactly. Yeah. One of my first rent to own money partners, he has since done, oh gosh, I can't even remember how many rent to owns he's done with me. And he's also then done a couple of regular longer term rentals with me as well. So So that money just kept recycling and building. And it's been fantastic for getting private, not a private lender, but a money partner for the down payments. So excellent.
Awesome.
Excellent. All right. Thank you for sharing. And now we will go on. So for today's menu, as I said, we're going to cover the basics of rent to own, how it works to make you more moolah, and avoiding potential pitfalls, some of the risks and avoidances for that. And then what's to come in future modules. Next week, we're covering marketing and your rent to own team. And module 3 is attracting and qualifying tenants, which is, of course, a huge key to rent to own. Structuring the deal and contracts for module 4, and a big key number 2. Those are the 2 most important things. And module 5, management to a successful sale. So, of course, not property management, but managing the deal and making sure it progresses. And module 6 are the specifics for tenant first rent to own, because there's a little bit more involved in tenant first rent to own as opposed to property first. And then also working with money partners. So some of this will be a little bit of review, but I want to make sure we cover everything all in one place. So, yeah, you will have seen a bit of this on the webinar before, but we just want to make sure we all remember everything. Okay, so why does rent to own rock? Well, first of all, real estate will always be the most secure investment because it is something tangible, something you can hold in your hands rather than just a piece of paper. And the market, of course, where did it go? The market, of course, has ups and downs, but the nice thing with real estate is that in the end, unless you're in a declining economy like a forestry town with pine beetles, then generally speaking, rent to own always goes up on average. And in fact, historically, it is, and I can't remember over how many years this was, whether it was 50, I think it might be over the last 50 years, that real estate statistically goes up approximately 2% above inflation, because of course, higher population, limited resource. So it's something that is indexed for inflation plus more. And money partners, of course, want a safe haven. Obviously, a lot of money partners are going to have other investments like stocks and other riskier investments in business ventures, but a lot of people want to park their money in real estate, and especially when it's a short-term deal, because if they're just parking it waiting for a bigger project, which has happened with us before, where yeah, they know that in a couple of years they've got this big thing going, but for right now they just want to make a good return in a safe haven. So it's great for that. And rent to own protects your portfolio in a couple of ways. It does insulate you from crises like the pandemic and the oil slump, which was a big deal in Alberta. We didn't get hit so hard by the 2008 recession, for as hard as some other people did. It wasn't as deep and long lasting for us, it seems, because of oil rather than manufacturing. So everything hits people in different ways. But the nice thing about rent to own is you've got a tenant that's locked in who wants to stay and complete the deal. So you're not going to have a vacancy just because somebody decides, oh, we could go and rent cheaper for somebody else. No, they're locked into this particular house with the rent to own. So that's good for that. And the tenants have what's perceived to be a vested interest. So they're going to pay the bills. They're going to take care of the property as if they already own it. So you get a much better quality tenant looking after your property and paying your bills. And are there rent to own tenants out there right now? Yes, there are. In fact, I've got we have a property right now that we just renovated and we're listing it for rent to own or sale. And we have interest in all three. So we do have somebody looking at it for rent to own as well. Now, Alberta, though, is expected to not, last I read, that we're expected to not really be affected by the little dip that we're having right now. So it really depends on where you are and exactly what your market is doing. Why rent to own? I love it because it's good for either an investment strategy or an exit. Now, as an exit, it is property first, rent to own. You already have the property, you're finding a tenant after you have the property already. And you can easily exit a property for $50,000 to $100,000 more by using rent to own, as opposed to conventional sale with a realtor. And as an investment strategy, that's tenant first, rent to own, where we find the tenant, qualify the tenant, get a maximum budget approved for them, send them out with our team, and they find the house within that budget. And that is very attractive to money partners because it's, as I've said before, it's that pretty little package with the predetermined exit strategy. And it's the quicker returns, which is good for both you and your money partner, because in regular rentals, you're usually not going to see any substantial amount of money for at least 5 years when you might be refinancing and pulling out some equity to reinvest or do whatever you want with. Or sell the property. But yeah, usually it's 5 to 10 years before you see any major amount of money. Whereas with rent to own, it's a 1 to 3 year on average time horizon. So much quicker return. And as I mentioned too, often the joint venture partners or money partners will recycle that initial investment and just keep going with more properties. So it's a great strategy. And of course, the tenants are better quality tenants. They are higher income earners. They're ready for the next stage of home ownership rather than just being regular tenants with no responsibilities. When is it useful? Tenant first, of course, works best in a rising market. The reason being that in tenant first, you're buying a property at often full market value. You're putting 20 or 25% down. And you usually will have, or often will have, a money partner on that. And we need the higher profits and bigger value appreciation so that we can give our money partners, our investors, a higher return on investment. Whereas with property first, you already have the property. You're not putting a new down payment on this property. You already have it in your inventory. Whether it's something you've had for a while or something you've just got with seller financing with nothing down. Either way, you've got this property with no upfront costs of down payment. You don't need a money partner, so you don't need the big appreciation or gains or profits to get that return for the money partner's $100,000 investment. So it can work in any market, especially when compared to a conventional sale. And even if now you wouldn't usually attract a tenant to sign into a rent to own deal if the market is already falling. But if the market starts to fall or dip after you're already signed in, it usually doesn't matter because you've got a lot of wiggle room with property first that still makes it work better than a conventional sale because of the additional profits and reduced costs. And we'll review that in a bit. So back to the very basics, what is rent to own? First and foremost, you have a lease or a rental agreement because first and foremost, this is a tenancy. And the tenant buyer, as we often call them, is not a buyer with equity. They have the option, the right to purchase the property with specific terms at a specific price, but they're not, there's nothing that guarantees that. It's just an option. So it's primarily a tenancy with the option or right to purchase the property if they are able to do so later. We always want the lease and the option to be completely separate. I have seen contracts where they are combined, and that really muddies the waters because then it looks like there is that equity position in the property, which we don't want to have viewed that way. And also, as soon as you have the option mentioned in the lease, now it looks like to the courts, if there is an issue, it looks like the tenant has that equity position or right to purchase tied into the lease that kicks it out of the tenancy tribunal and up to Court of King's Bench. Well, I actually talk more about that later. I'm getting ahead of myself. So we want the lease to not mention the option, so it stays tenancy plus the option to purchase. And your option agreement or option to purchase will outline all the terms, which covers the initial payment, the final price, the purchase price for the tenant, the monthly payments, and the purchase date when the term of the option is supposed to end. And of course, that will coincide with your lease. And it also covers the consequences. If the tenant defaults or violates the lease, breaches the lease in any way, what the consequences will be. And we will cover this in detail in module 4, where we'll go over all of the contracts. The important thing to remember is that there be no ambiguity whatsoever, because anytime there's any ambiguity or confusion in a contract, the decision will be made in favor of the person who did not provide the contract. So us providing the contracts to either our tenants or our money partners means any confusion will be decided in their favor. So we definitely want to avoid any ambiguity. So covering the rent to own exit, which is property first. That's where you want to or need to sell a property and you want to make more money than selling the conventional way. Again, it works in virtually any market, and you can make more money even if the market drops as compared to a conventional sale. So it can be a great addition to a fix and flip, because you already have this beautifully renovated property. Instead of selling it today for $400,000, you can do a rent to own, which is very attractive to tenants because it's a newly renovated property. And then you can add that extra 50 or 70 or whatever thousand more on top of your profit. Also great with agreement for sale purchases, which is a whole other course. But when we buy an agreement for sale, we're buying with seller financing, and we're often putting little to no money down. We get control of the property. The seller stays on the mortgage. So then our term is usually, our time frame for either buying or refinancing or selling the property to a third party is usually within about 2 to 4 years. So that's why it's a perfect exit. Rent to own is a perfect exit for a seller financed purchase, because usually a rent to own is 1 to 3 years. So you can, try to time that together, and great exit from a property that you know that you need to be out of in 2 to 4 years anyway. And let's review the numbers. Now, these are the same numbers that we covered in the webinar, but so go over them again, refresh our memories. So comparing conventional sale to rent to own based on a house value of $300,000. And usually if it's not a hot-bid market, then you're going to be negotiating a lower price with your buyer. And so let's assume $15,000, whereas with rent to own, you would be increasing the price over the term of the agreement. So potentially $15,000 more in 2 years. So you've got your $30,000 price difference right off the bat. And then with realtors and mortgage prepayment penalties with a conventional sale, your costs could easily be over $20,000. Whereas with rent to own, you've got costs of basically the professional photographer and a little bit of marketing, some cheap ads. And then the best thing about rent to own is you still get mortgage pay down for that entire time before the tenant buys. So that could be an additional $15,000 in your pocket. So that's a price difference, net price difference of $263,350 versus $329,000. So an extra $65,650 in 2 years on a $300,000 house. So that is a great thing. Oh, I should have put in the slide that really covers what happens if the market falls, because let's go back to this. So let's assume that the price actually decreases further and we don't get this $15,000 extra, and it could even go down by $15,000 in value over the term. So in that case, both of these prices would be $285. But because of the no costs for realtors and mortgage prepayment penalties, and because of the mortgage paydown over that time, even if your price actually went down over the 2 years by $15,000, you would still be making, let's add this up, $35,000 more, even if the price decreased. So it is a great exit. and rent to own as an investment or tenant first. So again, that's where we find the tenant, qualify the tenant, and send them out with our team. Sustainable business model in a rising market. You can just keep doing these the whole time. You do want to be paying attention to what the market is doing, because once it starts really heating up, that's when you want to pull back, because you don't want to be, so when we thought that the market was really reaching its peak, that's when we started pulling back our efforts and for marketing for tenant first rent to own, because we didn't want to end up halfway through a tenant first rent to own and have the market drop out. So when you're starting to look like the market is approaching its peak, you want to slow down and not use this strategy as much, because it's got to be rising for most of the time. Our average profit in tenant first rent to own was $60,000 per deal, and that's based on an average house price of about $400,000 and usually a 2-year deal. And our money partners were getting return on investment of over 20% per year in all of our past deals, except for one or two. I think one ended up being 15.8 or something percent, and another one was 19. So that was after we had to make some adjustments due to low appraisal or whatever, which I'll cover in a bit. But still, the money partners, they know that, first of all, that 20% estimated ROI per year is an estimate. It's not guaranteed. We're very clear on that. They're educated investors. They know that too. But they're still going to be happy coming back with even a 15% per year return, because first of all, it's safe and secured against real estate. And secondly, 15% is nothing to sneeze at. That's higher than you get at most anything that it is, especially that it's as low a risk as this. So yeah, if there is some wiggle room where things can be not so perfect and still end up just fine. Now we're going to go over this. You saw this in the webinar, but we're going to go over it in more detail here. I hope everybody can see it okay. So this is that $105,000 deal. The initial purchase price that we paid for the property was $605,000, and we put our money partner put 20% down, so that's 121. Sorry, the down payment was 121,000, but our money partner only had to put in 108,000 because the tenant buyer put in a 3% option payment up front of 18,150, and the so that serves to offset what down payment you're putting into the property, and that is another attractive thing for money partners. They're not having to put in the full 20%. So what happens is we are putting down the full 20 out of our bank account or the joint venture partner's bank account or whoever's on the mortgage, but then that option payment comes in and reimburses that portion of the down payment. So net is 108,000 invested. On this one, we were doing 5.5% per year increase, and actually the market went up substantially more than that. So the tenant buyer got a great deal when they bought the property. They had a lot of free equity, which was awesome. So that puts our 2-year price at $673,380. And the net profit from proceeds of sale would be $76,067. Monthly profits, $30,843, which means our total profit was estimated to be $106,909, and the investor's share would be $53,454.59, and that would be a return on investment of 24.7%. And we'll cover a return on investment calculation in a minute with a modified deal from this. But one thing to note is that if the investor were to use a home equity line of credit or even unsecured line of credit for a down payment, now the interest rates were pretty good at this time. They were a little bit lower than they are now, but not much. But the money out of pocket that the investor would be investing wouldn't be 108,000. Rather, it would be the interest expense that was coming out of their pocket. Otherwise, it's the bank's money that's going into the investment. So the only out-of-pocket money for the investor would be 12,528 in interest. So their return on investment is huge if they're using borrowed money. And of course, this is the actual profit and loss statement, which shows that the deal went pretty much exactly according to plan, which is again why money partners love these deals, because often it's just picture perfect and it works out exactly or very close to what the estimate was. Excuse me. But now let's get creative. So what happens if it's not as strong of a market? What can we do? So the less capital that you have invested in the property, or your money partner has invested in the property, the higher your ROI is going to be. So you can make the same profit, the 106,000, but if you're putting in less money, your ROI is going to be higher. Or on the other hand, if you make less money, for instance, 75,000, but you're putting in less capital, then your ROI is still going to be good. The less you have invested, the higher your ROI is going to be based on the same profit. So one way to do that is get higher option payments. So in our example, the $105,000 deal, we only got a 3% option payment. But once the market started to get a little bit slower, we wanted more security. And so we were asked, and we wanted to be able to increase the price less so that we could be prepared in case the market flattened off. So one way to do that is get higher option payments. We were asking then for 5% upfront. Now, of course, that means your tenant buyer pool is smaller because not everybody has 5% upfront. But that's what we wanted to do to make it less risky and to make it easier to get the same percentage ROI by having less money upfront. So with that 3% option payment, the tenant buyer did actually put down the 18,150. If we had been asking for a 5% option payment up front, then they'd be putting in 30,250. So that's over $12,000 less that the joint venture money partner would be putting in. You can also negotiate vendor take-back mortgages. Now, these aren't very common. There aren't a lot of banks that do them on investment properties. It's more common with owner-occupied, but it's still possible. And what those are is you still put in at least 10% for a down payment, but the rest of the down payment is kind of covered by the seller leaving equity in the property, and it's basically a second mortgage on the property. So the bank's happy because they're still only putting up 80% or 75%, and the rest is partly my money, partly the seller's money. But as long as it's not the bank's money, they don't care. So there are still some banks that do this, but it is, as I say, less common with investment properties. But it's a great way, if you can get one done, to do to greatly reduce your invested capital. And as I said, both of these strategies for reducing your upfront capital can make tenant first rent to own work even in a slower market where you're not getting 5.5% appreciation each year. So let's have another look at that the deal analysis, and we will work with this spreadsheet when we're in this deal structuring module so that we can play around with it. And of course, you'll all get a copy of it so you can work with it. But if we were putting in, if the tenant buyer was putting in more than 18,000 and our joint venture partner was putting in less than 108, then we would not need to get this high of an appreciation in order to make a good return on investment. So let's get specific here. So we still have the initial purchase price at 605,000, but the price increase, if we base it on only 3% per year instead of 5.5, then the final price to the tenant buyer is only going to be $641,844, not $673,380. So that's over 31,000 less in profits. So the total profit is 75,373 instead of 106,909. And if they're putting in a 5% option payment, which is the 30,250, then the investor only needs to put in 95,900 instead of 108,000. So we've got over 30,000 less profit, but 12,000 less invested. So of course, return on investment is calculated by your net income divided by the amount invested times 100 to make it the percentage, and divided by the number of years to get your ROI per year. So the partner's share of the profit, which was a 50% share, would be 37,686.50. And so our calculation, 37,686.50 in net income divided by the investment of 95,900 times 100 for the percentage divided by 2 years, we're still getting almost 20% per year return on investment for our investor, even with 30,000 less in profit. So that's what the power of a higher option payment can do for you to make these still work. Other benefits to rent to own are a higher cash flow, which is because you're getting top market rent plus potentially monthly option payments as well. And it's really important to know that you do need to charge full market rent in order for the tenant to meet the requirements for the bank's proof of down payment requirements. So for example, if market rent is somewhere in the range of $1,800 to $2,200, you need to charge rent of at least $1,800 for anything above that to be counted of your option payment to be counted towards the down payment when they buy. And I have heard of people structuring it where, okay, it's market rent is $1,800 to $2,200, they're charging $2,500 a month, but $1,500 of that is going towards the purchase of the property. Well, that's lovely. It can go towards the purchase of the property, but it won't count as down payment. So what you would need to do then is basically rewrite your contract to lower the price, because it wouldn't count as down payment because it's not above market rent. So it's really important that your rent be above market rent. Why is that popping up all of a sudden? Weird. Okay. Another benefit to rent to own is that when you have a tenant first, you have the lease in place before you even buy the property. So again, you get your tenant, you qualify them, you approve them for their maximum house budget, which let's say is 500,000. Then you tell the tenant, okay, based on your maximum budget, here is what your monthly payment will be. Here's what your upfront payment has to be. Here's what your final price will be. How does that sound? Excellent. Then you send them out with the realtor. They know that if they buy up to 500, that's what everything's going to be. Once they find the property, and of course, we're going to try to get a better price on it as well, then we will adjust the numbers for the final price, the initial option payment, and the monthly payments. We'll adjust the numbers based on the actual purchase price of the property. We write up the lease, we send it to the tenant, they sign it, they send it back. We don't give them a copy yet, a signed copy, because we don't own the property yet. And they understand that yes, just because they're signing a lease doesn't mean the deal is done. It still has to pass inspection and everything else. But once we do get into the applying for financing, we have the signed lease for the subject property that we're trying to get a mortgage on. And let me tell you, it makes it a whole lot easier to get a mortgage on a rental property when the bank already has a guarantee of what that rent will be. And especially because it's top market rent, potentially with the option payment on top of it. So they love it. So it makes it easier to qualify for mortgages, both for your subject property and also for future mortgages, because you've got that higher cash flow. Any questions so far? No? Okay. So again, who are our tenants? Of course, as I've said before, they're not high risk. They've already worked on their credit problems in the past. They have a blip in the past, but they have current good habits. They've already taken care of their collections. They've already paid down their debts. They've done their homework. There are some companies that do work with higher risk tenants, but those are also the companies who are happy to have a 50% success rate, which is not acceptable to me. We want to try to set every tenant up for success, and some people just aren't ready for this next step yet. So they are higher income than usual tenants, and that's because we want to have some wiggle room to make sure that they're going to qualify with the bank when the time comes. And we'll talk about that more when we cover qualifying in the other module. And again, they are fiscally responsible. They're not, shopping for new cars every 2 years. Now, we mentioned immigrants before, more on that. So of course, immigrants will come to this country, and a lot of them will either have a bunch of money with them, or perhaps they have a property that they're selling overseas and soon will have a bunch of money. So, and they're often highly skilled, or they're going to be starting businesses. So great fiscally responsible people, but they can't quite qualify for a mortgage because, for instance, with insured mortgages, they can get an insured mortgage regardless of how long they've been in Canada if they're already permanent residents with 5% down. And otherwise, it's 10% down. If you're not a permanent resident, it has to be 10% down. So they may not have the full 10%. So that could be a reason for them needing a rent to own. And of course, a lot of people just don't have enough down payment. Now, one thing with CMHC is there's kind of a magic number of 650 for credit scores. So once somebody's credit score is 650, then often they're able to qualify for a mortgage with only 5% down. If their score is less than 650, it's a slim to none chance that they're going to be able to qualify with 5%, and they'll probably need at least 10%. So rent to own is great for people who need to improve their credit and or save a bit more because they need that 10%. And we always like to encourage people to aim for 10%. We're usually only getting them up to 5% down within the program, but we encourage them to aim for 10%, and we're more than happy to put that in the program as the additional payments if they want to, have the secure savings, so to speak. Of course, people with short-term reduced income, again, oil slumps, recession, temporary layoffs, pandemics. So a lot of people will have the reduced income, and then they need 2 years of notices of assessment at the higher income before they can qualify for the mortgage. New jobs or business, it's the same story. Unless you're on salary with a contract, because then you can get away with, I believe it's 6 months of job history before you can get a mortgage. But if you're not on salary with a contract that guarantees your income, then you need 2 years of notice of assessment, and they take the average of those 2 years. And of course, with corporations, new corporations and new businesses, they want 2 years of those business tax returns as well. Again, credit blips in the past are often due to divorce or business failure. And that's something where the people are fiscally responsible. They've taken care of this. It's a big, ugly blip on their record that just needs to drop off a bit. Now with Property First, the tenants are selecting from a property that we have in stock, or sometimes if there's nothing we have in stock, but they're not in a hurry and they're not really fussy, they're just, we just want a house in this part of town that is 3 bedrooms, 2 bathrooms, double car garage, and otherwise, we're not really that fussy. Then you can put them on your buyer's list if you're doing those seller financed agreement for sale purchases, and you can target that area, target that type of property, and then get back to your buyer's list and see if it'll work. And if it doesn't work for them, if they end up not liking it, well, you'll find somebody else. It's not a problem. So So that's with property first. Usually it'll be from a property you already have in stock. Tenant first, they choose their home within your parameters, within the budget that you've approved them for, and then you send them off with your realtor and you buy the property off the open market, often at full market value or close to it. And again, we're going to cover your team, your rent-to-own team, in the next module next week. The tenants will have a perceived ownership interest. So it's less hassles because they're already treating the house like they own it. And they plan on owning it in the future. So they want to keep it up nicely. They want it to hold its value and be a good investment for them. The contracts and other documents are identical for tenant first and property first. The only difference is how the deal is structured. And we will cover that in the deal structuring module. Benefits to the tenants. The permanence and security of a forever home is a huge deal. I hear it all the time because people have, in one case, somebody was telling me that they had a home, their rental home was sold. And so then they went and found another rental and they asked the person specifically, are you planning on selling at any point in the future? And they said no, and the house was on the market 6 months later. So they were sick of it. That was one of the reasons why that was their biggest reason why they wanted to get into rent to own, because if you're locked into a rent to own, the owner of the property cannot sell the property out from under you, can't kick you out because their son is moving back in or their extended family. So you have that security of not being kicked out of your home. They have the opportunity to build their credit and their down payment while they're living in the house they're going to buy. And with building credit, you can report rent payments, both positive and negative, to the credit bureau, Equifax and TransUnion, through the landlord credit bureau. So there is a way for us to do it, and we can help improve our tenants' credit scores by reporting positive payments. And less landlord hassles is another big reason why a tenant will want to go into a rent to own. In our regular rentals, we don't hassle tenants very often. We do the spring and the fall inspections, and otherwise it's on an as needed basis. So usually it's, a dishwasher breaks. And so then our contractors will go in and they always report back to us if they see anything strange. But other than the spring and fall inspections and an as needed basis, we're not bothering the tenants. But there are a lot of landlords that I hear about that are either nosy, they're poking around, they're looking in windows, they're inspecting. I've heard of people inspecting the property monthly, and it's interfering, or at least borderline interfering with peaceful enjoyment of the property. And people get sick of that. When they're ready for home ownership, when they're ready for that step, they just want to get rid of their landlord. And with rent to own, because of the big option payment, which gives us security, and the fact that they're a higher income, higher quality tenant, we bother them a whole lot less. And our choice is we don't even do the spring and fall inspections with our rent to own properties. It's still something you can do, and that's up to each person to decide. But we don't do it, especially because when I was doing tenant first rent to own quite actively, that was all over the province. So I'm not going to drive up to Fort McMurray just to peek in the door. So yeah, we let that slide. And it's always worked out just fine because it's a different type of tenant. The values often increase more than the agreed price. So the tenants are getting free equity. And as I mentioned, the $105,000 deal, that was one example where they got huge free equity when they bought. And they can personalize the property, because unlike regular rentals where no, you're not painting anything. If something needs to be painted, I will bring my painter in because I know she knows how to paint. Most people think they know how to do improvements and repairs or painting, and they really don't. So in regular rentals, we don't allow anything from the tenants. Whereas in a rent to own, again, that big option payment gives us a cushion against all sorts of issues. So Our tenants are allowed to personalize by painting, by changing flooring. They can even change countertops, that sort of thing. If it's anything major that involves a permit, of course, that has to come back to us and we have to be consulted. So for example, if they wanted to add a patio door or finish a basement or build a garage, anything like that would have to be agreed upon with us. But hey, if they're adding value to the property, I'm usually going to say yes. Now, they can also increase the value of the property and build equity. Often that's by simple things like landscaping or building a deck or fences or something like that. But sometimes it's major renovations or major cosmetic renovations in the property. And that's why this little Superman is here. So we had a property, a rent to own in Medicine Hat, lovely bones to this place, built in sometime in the 70s. But yeah, great exterior, brick, beautiful place overlooking the ravine. And it was, I believe, 1,500 and some square foot bungalow, good layout, again, beautiful bones. But the basement was all original. And the upstairs was a combination of original and midway through very chaotic renovations. So the house looked terrible. We got a great price on it, which means that the tenant's final price was already going to be quite reasonable. And they did a full renovation, cosmetic only, of the property, flooring, cabinets, all that stuff, and made huge value for themselves. And little Superman comes into play because in the basement, there were a bunch of bedrooms, because 1,500 square feet, bunch of rooms in the basement. Each one had different wallpaper, and one of them was baby superheroes. And I'm so sad about this because the tenants actually promised to take a piece of the wallpaper and frame it for me or send it to me so I could frame it. And I guess they forgot. So I never did get my baby superheroes, but great opportunity for them to increase value and build equity for themselves. So, are you getting involved if the dishwasher breaks or just letting them handle and buying and replacing the dishwasher? It depends. If there's a problem with an appliance or a major system that happens right away, then we may get involved with that. If the dishwasher breaks 6 months down the road or a year down the road, no, they're responsible for repairs and maintenance and for any improvements that they put into the property. That being said, we also have it in our lease that if the landlord has to put up money for any repairs, for instance, if the furnace breaks a week in, and we're putting up the money for the new furnace because they don't have any money, they just gave it all to us for the option payment. It's written into our agreements that additional money that we put in would then be added to the final price of the property. So why is plain vanilla so important? When you're using the tenant first investment strategy, they're looking for their dream home, but it has to be within your parameters and it has to be a typical property for that area. You want it to be easy to resell if you get it back. So nothing weird about it, no perceived flaws. You don't want to be right across the street from Walmart or a prison or something like that. And you, for instance, if it's usual in your area for a bungalow with 3 bedrooms, 2 bathrooms, and a double car garage, that's the kind of thing you're aiming for. You also want to stick within a certain price range. So executive homes, for instance, are not something that I want back in my inventory. So I don't want to do rent to own on an executive home, on a really expensive home. I want to stay within, usually your tenants aren't going to be looking for a starter home because it needs to be something that they're going to be happy with for a long time, because rent to own does cost a little bit more than just buying it. So usually they're looking for 1 or 2 steps above a starter home. And anyone who's looking for an executive home, again, that is not where I want to be, because that's not something I want back in my inventory. Is if it fails and I get it back, I want it to be easy to re-rent, easy to resell, or easy to find another rent to own tenant. And if you've got, so for instance, we did have one where it was borderline executive home. So it's a $500,000 home in Beaumont, which is Beaumont's it's right beside Edmonton, and it's a little bit more expensive than Edmonton. So it was, you know, 4 steps above a starter home. So it's not executive, but not the usual plain vanilla. And of course, when that did fail, which it did because the oil slump hit, and both the people were oil executives and they both got laid off. So we got that back into our inventory, and that was a hard one to find a property first tenant for. So this was their dream home, great for tenant first if it had succeeded, but once you get that property back into your inventory, how will it look as a regular rental? Will it cash flow? How will it look as a property first rent to own? What does your market look like if you have it back in your inventory? Money partners. Again, they love the predetermined exit strategy and the increased certainty of having that pretty little package, of having the deal all set up and contracted. And the fact that when you set them up properly and qualify your tenants really well, your success rate will be high. And then you build that reputation with money partners where they keep coming back again and again and again. And cash calls are extremely rare because the tenant buyer is responsible for repairs, maintenance, and upgrades. In that one case with that home we got back in Beaumont, for the next rent-to-own tenant that we had, we did have a cash call on that one. And this is the only cash call we've ever had, because the next rent-to-own tenant had a big family and they wanted the basement finished. So we did a cash call on that one so we could finish the basement. And that is but of course, then the price of the home is higher because of that. So that's the only cash call we've ever had we've never had one for repairs or anything like that. So the money partners are getting higher returns, higher ROI, and the increased security. And they love that. It's an easy sell. And the shorter time horizon, again, is a great thing for them, especially if they're just parking money or just want to turn it over for income. Now, usually money partners are on tenant first rent to own because there's the big down payment, 20 or 25% down. So that's usually where money partners come in. But sometimes you will have a money partner on a property first. So regardless of whether you got the property by agreement for sale with seller financing or if it's something you already have in your inventory, you may want to do a big fix on it, a big renovation, and bring in a money partner to then do the rent to own on it. So a more common with an agreement for sale property, and you also, when you're buying with seller financing on agreement for sale, you sometimes do need to put down a substantial down payment, could be 10%, for instance. So a combination of the renovations and down payment, you may want a money partner on a property first as well. But either way, the returns, and on property first, the nice thing about that is the returns are usually higher for the money partner because, as I said, it might be 10% down instead of 20. So often higher returns. And we talk more about money partners in module 6, and we'll get into the specific wording, but we focus our communication on what attracts money partners to rent-to-own investments. So we're focusing on the predetermined exit strategy, the short time horizon, and the high return on investment. And we highlight why the tenant and property are a safe bet. Now, the tenant, and this, again, we cover it more in qualification, but the important thing about tenant security is their profession. So let's look back at the oil executives in Beaumont. Oil slump hits, they both are oil executives or some sort of engineer, not executive. They were some sort of engineers, oil and gas engineers, and they both got laid off. Whereas if they were plumbers, they would not have been laid off, because no matter what is happening in the real estate market or the economy, you always need plumbers. So there are certain certain trades and certain professions that are always in demand, and they are much more secure. So that is definitely something to consider when we're qualifying our tenants and when we're explaining the deal to our many partners. All right, any questions? Okay.
Hello.
Oh yeah, go ahead.
Was someone else there first or okay? Um, this is, so I noticed you mentioned it's better to buy a property for rent to own if you plan on, like, if it fits your criteria for your portfolio. And I think I've heard you say it's better to do the tenant first when you have like a renovated home for the most part to attract that good tenant buyer. But so I'm in touch with an older couple, and they want to sell their property, and it's in a weird little town. And I like helping people, so I was thinking an agreement for sale could be a route, to make the deal work for both parties. But the thing is, it needs repairs. So for fun, I put out an ad, and I've gotten a few people reach out to it. And I said something like, like a Kijiji ad mentioning a house with a possible rent to own option that needs repairs, and it would be perfect for a handyman. So I'm thinking if it now a handyman contractor reached out saying he is interested. And from there, I was like, oh, that's interesting. But I don't know, if I know there's a lot of variables involved, whether he's qualified enough or if he's qualified enough to even do the repairs nicely.
Yeah. Yeah,
So,
so it's definitely possible. And I mean, my people in Medicine Hat, they weren't professional, they weren't contractors, but they were very handy. They explained to me a lot about the projects they had done, and I had confidence that they would do a good, and plus nothing in this house was major to do. So it was all cosmetic. It was, replacing cabinets and pulling off wallpaper and painting, and then of course some things you're going to, they would be bringing in subcontractors for.
mhm.
So I had confidence that they would do a good enough job, especially because this place as it was terrible.
Mhm.
Nobody wanted to buy it because it just looked like so much work.
Mhm.
So it really depends, like you say, there are a lot of variables, but I had confidence that they would improve the property, and maybe it wouldn't be perfect, but it couldn't really get any worse. So that's one side to it, is really talking with them and seeing where they're at, and being very careful on agreeing, and should be in writing. There should be at the very least an email exchange about exactly what's what for instance, what they are confident and have experience doing versus what they should be hiring out. So a good
Yeah.
example is setting a ceramic tile backsplash. If somebody has never done it before, it could go terribly wrong. And
Mhm.
that's another one of those things where people just figure that they know how to do it, even if they don't. So you got to
Yeah.
be really careful with that. The other thing is there's a much smaller market for people who want to get into that. So you might be getting it on agreement for sale, but you would need to be prepared to do the renovations yourself or have somebody do them, and then bring a tenant in, rather
Okay.
than relying on bringing in a handyman type tenant.
Okay. So even if you have a handyman type tenant, would it be acceptable if it was only cosmetic, perhaps, or basically it's something I should avoid entirely?
Well, no, it can be done. And you also could have a tenant that is, uh, I mean, if it was a full renovation, it is possible that you would get somebody in who's a flipper, who
Yeah.
has done this before
Okay.
and won't even be living in the property, and is just going to take advantage of the fact that they don't have to, put a big down payment on. They're getting the property under contract with rent to own, they're fixing it up, and then they're either going to refinance it or sell it or whatever, or potentially move in themselves. So it is possible, but again, like I say, it's a smaller market that you're looking at of people who are A, going to want to rent to own, and B, going to be willing and able to do all this work. So for the one that I did, that was a tenant first rent to own, where we had agreed in advance that they were looking for a project house.
Okay.
And then it was a tenant first rent to own, where they picked the project house. And I even drove down to Medicine Hat to check it out, because I gotta, it's a project house, I gotta see what's going on.
Mhm.
So yeah, so it really, really depends. All right. Does that answer your question well enough?
Yeah, definitely.
Perfect. Any other questions? Okay. So the potential pitfalls, and hi Sam, I see you joined us here. Nice to see your not your face, your name. Potential pitfalls of rent to own. We're going to cover each of these, but I'll just list them first. The market could drop. You could get an artificially low appraisal. The tenant may not be able to buy at the end of the term. The tenant could default. And there could be legal issues, and there could be something I haven't encountered yet. You never know. If anyone has any other thoughts on potential pitfalls, please let me know. All right, so the first and most important thing in avoiding pitfalls is having a big option payment. The bigger the option payment you get, the more security you have. So as a good example, that project house in Medicine Hat, I made sure they had a big initial option payment, because if they defaulted and I got the property back as a half-done project, that would be a big deal. So anything out of the ordinary, you want a bigger than normal option payment to give yourself more security. And so that could be the initial option payment plus monthly or lump sum payments. All adds up for your option. With the bigger option payment, the tenant is less likely to default. And it's a bigger cushion for you if the tenant does default. You've got more money to fix up their renovations, or to prepare the property for resale, or whatever you need to do. And the tenant is more likely to purchase if they have a bigger option payment, because they're further along in the process. They're already that much closer to having their full down payment and to being able to buy the property. So always good to have bigger option payments. The next important thing for avoiding pitfalls is setting expectations and providing guidance. And one thing that our option disclosures addendum does, which we'll cover in the contracts module, one thing that does is to really set expectations and also provide the guidance by giving hints on how to improve credit. And it's basically a full list of what to do and what not to do. So that is important for avoiding pitfalls. And of course, clear, unambiguous contracts with full transparency. And this applies to both your tenant buyers as well as your money partners. If everything is clear and concise and completely transparent, then it's going to help avoid pitfalls. Now, surviving pitfalls. So if the market drops, does it really matter? What is the value of the property? How much wiggle room do you have that you can make adjustments? So sometimes it doesn't matter if the property market drops. And a couple options if it does. Do you want to renew? Is it expected to just be a little blip? I was talking to somebody in Ontario, and the blip that they're having right now, they're expecting to be done, at least in that area, expecting it to be done by the end of the first quarter next year. Well, that's a pretty little blip. So in that case, you might just want to renew and see what happens with the market at that time. Or you can just, if they're ready to buy the property now, you can lower the price, negotiate a lower price, or you can negotiate a payment plan for the difference. And often what you'll do is both. So remember, you don't need to lower the price because the tenant has committed to the price on the contract. You are not obligated to lower it at all. And in fact, in my options disclosure, it stipulates that there is no guarantee that the market will support this value when the time comes to buy. It says right in there. So we're not obligated. We've made it very clear that this is a possibility. The market could drop and it might not be supported. But it's just good business sense to negotiate a win. We want a win-win. So what I usually do is lower the price a little bit, and then often we'll also have a little bit of a payment plan for the difference, and everybody's happy because the tenant is getting closer to what they need. We're still getting a good return. Our money partner's still happy. It might not be 24.7%, but it still could be 19.6. So it works that way. If it's a low appraisal, again, it depends on whether it's an artificially low appraisal because it was a mistake. That's really what I mean by low appraisal, is that the appraisal was just out to lunch, and who knows why. That has happened on 2 occasions for us. Now, if it's not an insured mortgage, you can get a new appraisal. It really depends on which bank the tenant buyer is working with, though, because some banks really want to work with the first appraisal. Some will take the second appraisal if that second appraisal is justifying why the first one was low. And some will split the difference. One example of the bank taking the new appraisal is actually a personal example for me, because we were refinancing a legally suited property and we got this ridiculously low appraisal. And I said to the bank, no, this is what the property would be worth if it was just a house with a finished basement. That's not what this is. This is a legally suited property that automatically adds at least, well, it's about 10% in value in our area. So based on that, they took the new appraisal and threw the old appraisal out. Now, if it's an insured mortgage, last I checked anyway, CMHC would only take the first appraisal. They would not do another one. And that was one reason why we had to make special arrangements with one of our tenants, or 2 of our tenants, because it was a ridiculously low appraisal, but we couldn't get another one because it was an insured mortgage. So, and we both agreed, the tenants agreed too, that this is ridiculous. This is not correct. So again, you have the choices of negotiating a lower price or negotiating payment plan for the difference, or again, both. And even though we agreed that the appraisal was ridiculous and the house was actually worth what the contracted price was, we still knocked a little bit off the price and then did the payment plan, just to, again, create a win-win and make sure that we have good rapport and business relationship. If the tenant can't quite purchase, then, but they're on their way, they're doing everything they need to do, they're saving down payment, they're improving their credit, they're paying down their debt, all the things that they need to be doing, then usually the best option is to renew. What we would do is have the tenant consult our banker, mortgage specialist, to determine what time frame might be required. Sometimes it's only 6 months, sometimes it might be another year, depends on what the issue is. So in the case of renewal, you can negotiate new terms, obviously a new date, but also potentially a higher price. If it's only for a few months, I would usually leave the price the same unless the market had jumped dramatically. But if it was a year renewal, I would definitely look at increasing the price. And when you're renewing the agreement, you're probably renewing the underlying mortgage. So there may be higher mortgage payments and therefore may need to be a higher monthly payment. And if the tenant defaults, all option payments that they have made, both the initial and the monthly, are completely non-refundable if they walk away from the deal. So then, now that's as, if the term is officially as liquidated damages and not as penalty. And that's a very important legal term to have in there. And it's liquidated damages. We're taking that money it's not as a penalty. We're using it to refresh the property, get it ready for sale or rent to own to somebody else, and potentially marketing expenses, because if we just do a straight out sale at this point, now we've got realtor's fees. The property is usually in good condition when we get it back, even when somebody has defaulted, because remember, these are just higher quality, higher caliber tenants. So the one exception that I can think of where I didn't get it back in at least as good a condition as what we could put it out as, the tenant was a tradesperson, and I think he got in the habit of wearing his work boots in the house. So up the stairs, the carpet was stained, but it didn't really matter because that carpet was 10 years old anyway by this point. So it needed to be replaced regardless. So that was the worst we had out of any default. Of course, we haven't had a ton of defaults, but you know, you do a lot of deals, you're going to get a few. Now, if the tenant defaults because, and this really depends on the situation, because if they've been laid off and it's just a bad situation, if there's any money left of the option payments after I've refreshed the property and marketed and gotten it sold or rented to own or rented to somebody else, then you have the opportunity to refund some of the excess money. You don't have to, you're not obligated to, but it's a nice gesture to give them a little bit of money back if you can, because they're walking away from a failure and a big chunk of money. Legal issues, of course, are always possible. Now, what we want to be sure of is that we have the lease and the option separate. As I mentioned before, that's the difference between working with the tenancy tribunals. If it's just a straight out eviction for non-payment of rent or other sort of default, or it getting kicked up to the Court of King's Bench because of a perceived equity position in the property. So if there's any complications by having the lease and option together, it'll get kicked up to Court of King's Bench. It won't be a simple quick eviction. So very important there. And of course, as with all business ventures and even in life in general, anybody can sue anybody for any reason or even no reason at all. So it's always possible that somebody could sue you. But if you have the solid contracts with the clear, transparent expectations, everything laid out, it's highly unlikely. And even if they did, they're not going to win. So that protects us. All right. And that is it. So let's tackle any questions that you have, and then we will wrap it up. And of course, you can email me if you think of a question later, because I definitely will answer anything right now.
Who carries the insurance or liability?
We have a fantastic rental property policy. It's through Peace Hills, and my broker, Peace Hills, has this policy across Canada. I think that Sadler Insurance, which is my broker, can work with anybody across Canada, but I'm not 100% sure on that. But yeah, it's a fantastic policy that has tenant vandalism coverage, flood coverage, the whole bit. And so I would have that insurance. And of course, the tenant would have tenancy insurance, because, and that's especially important in rent to own, because if they're going to do any improvements to the property, then you know, add a deck, whatever, then they need to have some extra insurance too. But yeah, we have the property insurance, they have the tenancy insurance. Any other questions?
Just about, what about changes in interest rates? Has that affected your in the qualification?
Well, when we do the qualification, and that's why I say tenants, rent-to-own tenants are higher income than regular tenants relative to the property, because we're qualifying them with a much bigger cushion than if they were actually getting a mortgage today. So, and I've had a lot of, especially when we were in a low interest environment, and I'm using my big cushion to qualify them, and we'll go over that in the qualification session. But and I had the people say, well, you know, I spoke to a broker and they said I could qualify for 500,000, and you're saying I can only get a $400,000 house. Yes, because you're not buying that $500,000 house today. You don't know what's going to happen between now and the time that you're going to be able to buy the house. So interest rates could go up, for example, and that us qualifying you for a smaller amount helps to ensure that you're going to be able to buy the property when the time comes, regardless of what happens with interest rates. So yeah, we've been in this situation before.
All right. Okay. How do you use appraisers to establish the initial values and the value that's going to escalate, or
Well, when it's a
afterwards?
tenant first, then yes, it's getting appraised and we're buying. So back a step. If it's tenant first, let's say that the property appraises for 500,000, but we're buying it for 450. We're still going to start with that purchase price, even though it's lower than the appraised value, because that's just how I structure it, because that gives the tenant buyer the best chance of success. And if they've already got free equity in the property before we even get started, there's a huge chance that this is going to be a successful deal. So when it's tenant first, we go with whatever the purchase price is, regardless of what the appraised value is. Because the appraised value is always going to be at least that high, because we're getting a new mortgage. So it's going to be at least that high. With property first, we will often, we may get an appraisal done if we have any, just to establish that baseline. With property first, it's also really important if you're changing use of the property. So let's say this was your secondary, your vacation home, or even your personal residence, and now you're buying a different property and you're doing this a rent to own, so you're changing use. You absolutely need a professional appraisal then. But with property first, you don't have to get an appraisal. You can just use your trusted realtor and get a comparative market analysis. So that's one way to do it, which is a big step below an appraisal, but it's still, you know, fairly comprehensive. But yeah, it's also just whatever the market will bear. So it's not necessarily what the appraised value is, but I'm starting it with my buy now price as to whatever the market will bear, whatever people are going to be interested in the property at. So I might say, okay, well, let's start at 450. And if I don't get any bites on the property, well, then I might lower it. But yeah, I'm going to start out with the highest possible initial price, and I can always adjust it down later. Anything else? Excellent. Well, I do have a Facebook group that you can join. It's not really active. We don't have, we have, I don't know, over 100 members, but it's not really active yet, but it will be more active once more people join. So feel free to request to join the Facebook group. And that's just Real Estate Insights in Groups, or the name is Creative Real Estate Investors Mastermind. So feel free to join that. And we will see you here, same time next Wednesday for marketing and your rent to own team.
Okay.
All right.
Will you
So,
send out a new Zoom then?
pardon me?
You'll send out a new Zoom?
Oh, yes. Yeah. And it's so you'll find in that first email that I sent that has the Zoom invite, it has the link for all of them. It should actually be the same link because it's a recurring meeting. So it should be the same link for all of them. But in all the reminders, I will send the link again. So it should.
I couldn't get that to work somehow.
Really?
Yeah. It could.
Well, I'm glad you're here.
No, I got your email just before, but yeah. All right.
All right. Yeah, I will be sending it out again. And excellent. We will see you next week if I can get this to
All right.
meeting. Great. Well, thank you for joining me, and I'll have everything up in the membership portal within the next few days. I'll see you next week.
Right?
Missed the button. I hate this end button. It never works for me.